Right now, India is launching a brand new system designed to turn dirty industrial exhaust into a tradable financial commodity. The country is currently managing a period of intense industrial expansion, while simultaneously working toward a hard 2070 deadline for reaching net zero emissions. Reconciling rapid economic growth with a 2070 net zero commitment requires a mechanism that forces profit-driven sectors to assign a concrete value to invisible gases. The government is betting that the most effective way to drive this transition is to ensure that carbon emissions carry a direct, inescapable impact on a company's quarterly earnings. This approach aligns with a massive international trend. In 2025 alone, global carbon markets reached a record valuation of $79 billion. India has now activated its own carbon market portal, creating a digital infrastructure to track and monetize emissions reductions nationwide. With actual trading expected to start shortly, the nation is establishing an entirely new domestic financial exchange from the ground up. By formalizing this market, India is positioning its green transition to capture a significant share of the multi-billion-dollar momentum in the global climate economy. The system operates on a mechanism known as cap and trade. It begins with a cap, a strict legal limit on the pollution a facility can release. If a factory exceeds this limit, they produce excess pollution, creating a financial liability. However, if a facility uses cleaner technology to stay below the cap, the government converts that unused allowance into digital carbon credits. To avoid penalties, the overpolluting company must purchase these credits, effectively paying the cleaner company for their efficiency. This creates a mathematical loop where clean air is treated as a liquid asset, while excess pollution becomes a measurable debt. This structure forces a total recalculation of industrial overhead. For legacy plants relying on high-emission processes, the need to buy credits becomes a constant, recurring drain on their cash flow. Conversely, for modern solar or wind installations, every kilowatt of clean power they generate now carries the added value of a tradable credit. These clean energy producers gain a new revenue stream, while the country's highest emitters are legally transformed into their primary customers. In this environment, the cost of efficiency is baked directly into the profit margin, making emissions reduction a core requirement for remaining competitive. However, the integrity of this entire system depends on the credibility of the credits being traded. If a single digital credit doesn't represent a real, verified ton of carbon removed from the atmosphere, the market loses its environmental value. Experts warn that if oversight is weak, or if credits are granted for green projects that don't actually function, the pricing mechanism will fail. If credits become artificially cheap, heavy industries will simply buy them up as a cost of doing business, rather than spending the capital to actually modernize their factories. Without transparent and ironclad regulation, a system designed to fix the climate risks becoming a loophole that allows companies to simply pay a fee to continue business as usual. India is currently defining these rules as the first wave of domestic trading begins. The success of this portal will be a deciding factor in whether the nation can meet its 2070 net zero commitment while maintaining its industrial pace. The question remains, will this market successfully engineer a cleaner environment, or will it evolve into a new form of high-stakes financial speculation? Ultimately, the value of India's multi-billion-dollar gamble won't be found in trading volume, but in the physical quality of the air the nation breathes.